I mean, look, we talked about this yesterday in overtime. The data this week has been very encouraging. It wasn't just, the non-farm payroll numbers this morning, but it was the JOLTS number. I know it's rolling a little bit, but it's still really elevated out there. And initial claims, they are inching higher, but they're still really low. And then we talked about factory orders being better than expected, right? And we talked about the prices paid indexes with inflation coming down. And we talked about new orders in the ISM reports being close to 60 at the level. So in my opinion, like the economy, we can handle higher interest rates, especially after the job report this morning. We just created 3.2 million jobs year to date. We have an unemployment rate at 3.5%. I don't think that the Fed pivoted at all a couple of weeks ago. How many officials told us that today? So there's really no reason for them to pivot. I'm not worried near term, Scott, as you know, right? I'm worried more about 2023. I'm worried more about 2023 because we don't know what all these rate hikes are going to do to the economy down the road. But for now, things look pretty okay.
You know what? I'm wondering, Rob Sechan, if it's time for us to pivot. Forget the Fed. Maybe it's time for everybody to pivot from recession is almost inevitable to soft landing. How about that?
Well, last week on the show, Scott, we pivoted from cautious to cautiously optimistic and thought that this bear market rally, we still think we're in a bear market, had some legs because we saw great measures of momentum and breadth, specifically related to any of the other rallies that we've seen year to date. Investors clearly got too short, too bearish, and the pain trade was higher, and the rally in bonds boosted PE multiples. But interestingly, right now, despite what we've seen this week, all those measures have stalled out or have stopped improving, and now we're sitting at some pretty significant resistant levels, and we have to see if we're able to break through. What would cause markets to get weaker is that the bond market's already priced in all the good news. You look at the 2-year and how it was pricing in cuts in early 23. That has started to pivot again. And so I think this hot jobs number was really, really important because it changes the outlook for rapid Fed accommodation. And this data is not what the Fed wants amidst a weakening economy and kind of a strong market. Financial conditions.
Maybe it is what they want. Maybe it is what they want in the crude sense that it emboldens them. They want to be able to hike rates to where they want to take rates and know at the same time that the economy can absorb all of it. That's been part of the view from the beginning.
I would hypothesize, Scott, though, what does that do to valuations if they're able to continue to do that? We're trading at some pretty lofty levels right now, and I think valuations act as a significant cap for any price performance from here. And to Chris Toomey's point yesterday, Chris Toomey made a point on your overtime yesterday that earnings have yet to come down. I mean, come on, we still think there's going to be 8% earnings growth next year? I don't think so with the economy decelerating and the Fed still completely engaged. I don't see it.
You mentioned these resistance levels. Krinsky, BTIG, who we cite and we have on our program all the time, Sarat, says if the S&P closes above 4231, 4231, the June was the low. Now we're like 110 points away from that, so we still have some work to do, and maybe there's some significant resistance to get to that point. But what do you make of that, along with this hot jobs report, with the view that the Fed's going to be rock solid strong here? Maybe the economy can handle it, maybe it can't. We're going to find out.